Something does not add up. The world's largest asset manager, a firm that oversees more money than the entire GDP of Japan, is quietly, systematically, and deliberately accumulating an asset that every central bank on Earth cannot print, cannot seize, and cannot inflate away. At the same time, those very central banks are printing money at a pace that would have been considered criminal a generation ago. One side is buying the exit. The other side is manufacturing the emergency. The question is not whether you understand Bitcoin. The question is whether you understand what BlackRock understands, and why they are moving with a speed and a conviction that institutional investors reserve for only one type of moment in financial history. The moment just before everything changes. Here is what the mainstream believes. Bitcoin is a speculative asset, a digital gold alternative that attracts retail investors, technology enthusiasts, and ideological libertarians who distrust central banks. When times are good, people buy it. When times get scary, they sell it. It is volatile, it is unpredictable, and its value is ultimately derived from collective belief rather than fundamental utility. BlackRock's entry into Bitcoin, according to this narrative, is simply product development. Institutional investors demanded exposure. BlackRock built the vehicle. The iShares Bitcoin Trust is a fee-generating product designed to capture a market that was going to exist with or without them. And the money printing? That is also explainable on the surface. Governments borrow to fund services their tax revenues cannot cover. Central banks buy government debt to keep interest rates manageable. Inflation is a side effect, not a feature. It is being managed. It is under control. The system works, imperfectly, but it works. This is the story most people are operating from. It is not wrong, exactly, but it is catastrophically incomplete. Because when you look at what BlackRock's most senior strategists are actually saying in private meetings, when you look at the pattern of institutional accumulation against the backdrop of sovereign debt levels that have never existed before in peacetime, when you look at the mathematics of what is happening to every fiat currency simultaneously, a completely different picture emerges. And it is a picture that should make every investor deeply uncomfortable and deeply curious at exactly the same time. Let us start with a number that almost nobody talks about outside of institutional research departments. Global debt is now approaching $310 trillion. Not billion, trillion. 310 of them. To put that in terms the human brain can actually process, if you spent $1 million every single day since the birth of Christ, you would not yet have spent $1 trillion. The world is carrying 310 of those. And here is the part that does not make the mainstream news. That number is not shrinking. It is not stabilizing. It is accelerating. Every percentage point of interest rate increase adds trillions more in debt servicing costs to governments that are already spending more than they collect. Every recession forces more borrowing. Every crisis demands more intervention. Every intervention requires more money creation. The system is not managing debt. The system is addicted to it.
We're kind of exiting this, say, 40-year period of monetary dominance, and then we're entering this period of fiscal dominance. But then there's the case that inflation is a spectrum. And so, for example, over the past 100 years, waterfront property has been very scarce, followed by fine art and gold, which are pretty scarce. And then there's things like oil, which we have gotten better at finding, but it's still fairly an energy-intensive and scarce process. And then you go down to soft agricultural products, grains and soybeans. They'd be very good at making more of over time. Things like electronics. And so you have this spectrum. And if you're holding things like dollars or treasuries over the long period of time, the things where the productivity growth is coming from are probably not getting more expensive than you. Like $1 can literally buy you more television than it could 20 years ago. For a couple $100, you can get a decent television that's better than the television you could have gotten 20 years ago, because the productivity growth of making televisions has exceeded even the debasement rate of the dollar. Same thing for a lot of electronics and some textiles and things like that. On the other hand, if you were holding gold, then not only did you keep up with that, you can buy multiple TVs for the same amount, the same ounce of gold you could before. And Bitcoin's not been around for 20 years, but basically over time, if Bitcoin is successful at growing in adoption and remaining scarce, then you could buy even more televisions. Basically, you still want to, no matter what productivity growth is relative to the fiscal deficit, the debasement that's happening, you still don't want to hold the denominator that's diluting you. And instead, you want to hold the things that are scarce and attractive and that are at the top in their game, right? So, you want to own the big tech monopoly stocks, whatever the trends, like whatever is dominant, you want, and not heavily diluting its shareholders. That's what you want to own, or gold, or Bitcoin, or certain high quality real estate that you can. One of the best things about publicly traded companies in real estate is you can also attach a fiat currency short to it. You can attach a 30-year mortgage. So if the money supply is growing by 7% a year, there are people that took out 3% mortgages. And you're on the right side of that. You're shorting the currency that's getting diluted, and you're buying a house, which gets slowly diluted and has maintenance and taxes. You're kind of arbitraging that spread. And the same thing if you buy like a blue chip stock. Like why? Procter & Gamble's been around for like a century. They've been profitable for decades straight. Why do they have debt? Like they have billions of dollars in debt. And the answer is because they're arbitraging that. They're using that fiat currency short. Because they can issue, until recently, they could issue like bonds at 2% yields for 5, 10, 20 years. And they're shorting fiat currency against their more valuable equity and the assets that they own and the cash flows that they can increase prices on over time. And so basically the combination of owning fairly scarce things that maintain market share in their space, and then either having, and then shorting things that are rapidly increasing in supply and therefore not retaining their value.
What Lynn Alden is describing beneath the surface of her careful academic language is something far more alarming than a policy debate. She is describing a one-way door. Once a monetary system reaches the debt levels the developed world is currently carrying, the historical record is unambiguous. There are only two exits: default or debasement. And no democracy has ever voluntarily chosen default when debasement was available. Debasement means printing, and printing means that every dollar, every euro, every yen sitting in a savings account loses purchasing power, quietly, continuously, and invisibly, without a single headline, without a single admission, and without a single politician accepting responsibility for what is happening to the value of ordinary people's savings. Now, here is where BlackRock enters the story in a way that most analysts are missing entirely. BlackRock does not manage their own money. They manage yours. Pension funds, sovereign wealth funds, university endowments, the retirement savings of millions of ordinary people who will never attend a single BlackRock board meeting or read a single BlackRock strategy document. When BlackRock builds a Bitcoin product, they are not making a speculative bet. They are responding to an existential pressure that their institutional clients are beginning to feel acutely. The pressure of watching their assets denominated in currencies that are being systematically debased faster than any traditional asset class can compensate for.
It's the first time we've had an opportunity to talk to you about it, which is Bitcoin, the Bitcoin ETF.
I probably switched. For the first 3 years of thinking about it, I was a naysayer, and about 2 years ago I switched, and I'm actually, as I said in the last 2 years, I'm a big believer.
Are you a believer personally? Meaning, is the Fink family a Bitcoin buyer or a buyer of this new ETF?
Well, now I could do that. I cannot, I don't want to compete with our clients, so I don't buy single assets. I'll buy mutual funds. I'll buy single ETFs. So I have an opportunity to do that now. But I'm a believer in it because I do believe it is an alternative source for wealth holding. I don't believe it's ever going to be a currency. I believe it's an asset class.
You don't believe it ever becomes a currency?
No, I think we're going to create digital currencies. We're going to use the technology for it. We're going to use the blockchain. I believe, I believe it goes up if the world is more frightened, if people have fearful of geopolitical risk, they're fearful of their own risk. It's no different than what gold represented over thousands of years. It is a asset class that
protects you. Right?
What we are trying to do is offer an instrument that can store wealth. I think if it gets that even close to that high, gold will represent even a bigger value. And let's be clear, if you think of digital gold, there's going to be a reference point between gold and Bitcoin. Let me be clear, I think ETFs are step one in the technological revolution in the financial markets. Step two is going to be the tokenization of every financial asset. And to me, this is where we believe it's going. So we're looking at Bitcoin, we're looking at ETFs in the same manner. These are technological changes that can allow us to move forward.
Listen to what Fink is not saying as carefully as what he is saying. He is not excited about Bitcoin as a technology. He is not a convert to the Bitcoin philosophy. He is responding to client demand that is itself a response to something his institutional clients are seeing in their long-term asset liability models. The models are not balancing anymore. When you manage money across a 30-year horizon, which is exactly what pension funds do, and the currency your liabilities are denominated in is losing real purchasing power faster than your assets are gaining it, you have a structural problem that no amount of equity allocation or bond duration management can solve. You need an asset that sits outside the monetary system entirely. An asset that cannot be debased because it cannot be created. An asset with a supply curve that is defined by mathematics rather than by a committee meeting in a central bank. This is not the first time in history that institutional money has sought refuge in an asset outside the control of governments. In the 1930s, as the United States grappled with the aftermath of the Depression, gold served that function again. Investors who held gold through the debasement of the dollar in 1933, when Roosevelt confiscated gold and repriced it from $20 to $35 per ounce overnight, experienced what every monetary transition eventually produces. The people who understood what was happening before it happened were protected. Everyone else paid the invisible tax of debasement without ever receiving an invoice. In the 1970s, as Nixon closed the gold window and the world moved to purely fiat currencies for the first time in modern history, gold served that function again. The investors who recognized that the monetary anchor had been removed accumulated hard assets and watched their purchasing power compound, while the dollar lost half its value in less than a decade.
So my whole framework is built on something I call the Everything Code. And the Everything Code was the understanding that global liquidity is the key driver. People have caught on to this over time, but global liquidity explains 90% of the moves in Bitcoin. So let's talk about liquidity. Last year was a year where everyone was, including myself, was expecting more liquidity. It tends to come in seasonal phases. Liquidity is generally being used to debase the currency to pay for the debts, and particularly the rolling of this massive debt load. That had been a 4-year cycle, and then last year it started. We didn't see the pickup in liquidity we're expecting, and that led me to try and understand what was going on, why it had changed versus my forecast, and I realized that the debts had been extended by another year, so therefore the cycle was probably a 5-year cycle. Okay, so that gave us an understanding. We should have still had a good end to the year. Normally, Q4 is good in crypto, or at least November, December is, and it wasn't. It was the opposite happened. And that was based on, again, liquidity, because we had the government shutdown. And the government shutdown, well, it first started in July, where the Federal Reserve, planning for the potential shutdown, started rebuilding what's known as the Treasury General Account. That's their checking account. When they do that, they're taking money out of the system. It used to be offset by something called the reverse repo, which they've been draining over the last 2 years, and that was empty. So you had a slightly outsized effect. Also, Chinese liquidity hadn't picked up yet. So we had this liquidity air pocket. Okay, that's pretty normal. These things happen. Then we had the shutdown. Nobody expected the longest shutdown in history. Certainly I didn't. And what you got was a decoupling of crypto, which is the furthest end of the risk curve, because it got hit by this lack of liquidity because nobody could spend any money in the government. So liquidity wasn't there. That caused October the 10th. October the 10th was a crypto-specific event where everything broke basically on Binance and a few of the Asian exchanges, and everybody got liquidated in the largest liquidation event in history, and the market has not recovered from that yet. There's a bunch of theses why it hasn't recovered yet, but it's repairing itself, which is why we've had this choppy sideways price action for a long time, while other assets have been screaming to new highs. So does it mean that it's over and the 4-year cycle's over? No, because we can actually forecast liquidity. We do it a number of ways. One is look at financial conditions. They're weakening, and the dollar at a new low for this cycle today is a huge indicator that financial conditions are weakening. Bond yields over time have been either stable or trending lower. That's another input to liquidity. Commodity prices starting to pick up, which is a slight offset. But generally speaking, financial conditions are improving. That leads global liquidity.
If this thesis is correct, and the weight of evidence from institutional behavior, monetary history, global liquidity mechanics, and geopolitical currency competition suggests it is directionally accurate, even if the timing is uncertain, then several things follow that most investors have not yet priced into their thinking. The first is that Bitcoin's volatility is not an argument against it. It is a feature of its early adoption curve. Every transformative monetary asset in history was volatile during its adoption phase. Gold was volatile when it was competing with silver for monetary dominance. The dollar was volatile during the Bretton Woods period. Volatility is not evidence of instability. It is evidence of price discovery in an asset whose ultimate addressable market, global reserve asset, is orders of magnitude larger than its current market capitalization. The second is that the competition for Bitcoin is not other cryptocurrencies. The competition for Bitcoin is the existing monetary system, and the existing monetary system has structural problems, debt levels, debasement pressure, geopolitical dollar challenges that are not solvable within the system's own architecture. Bitcoin does not need to defeat other cryptocurrencies to win. It needs to be the best available alternative to a monetary system that is slowly losing the trust of the institutions that have historically been its most reliable defenders. BlackRock becoming one of those institutions is the most significant signal in that competition yet. The third implication is the one that should concern every person watching this video who has not yet thought seriously about their exposure to this thesis. The wealth transfer that occurs during monetary transitions is historically the largest and fastest transfer of purchasing power between economic classes in recorded history. The people who understood what was happening before it became consensus, the people who held gold before the Nixon shock, the people who held real assets before the Weimar hyperinflation, the people who held hard assets before every major fiat currency collapse in history did not just protect their wealth. They captured the wealth that was being transferred away from everyone who did not understand what was happening. Bitcoin is not a guarantee. No asset is a guarantee. The risks are real. Regulatory intervention, technological challenges, the possibility that the timing of the monetary transition is slower than the thesis suggests. These risks deserve serious consideration. But the asymmetry of the opportunity, being early to an asset that institutional capital is only beginning to accumulate, whose supply cannot be increased regardless of how much demand appears, whose adoption curve is still in its earliest institutional phase, is a risk-reward calculation that BlackRock's risk management department has already made. The question is whether you have made it too. Satoshi Nakamoto published the Bitcoin white paper in October 2008. The timing was not accidental. Lehman Brothers had collapsed 6 weeks earlier. The Federal Reserve was preparing its first round of quantitative easing. The global financial system was revealing, for the first time in the modern era, exactly how fragile the architecture of money built on trust and government promise actually was when that trust was tested. Satoshi did not create Bitcoin because the technology was interesting. Satoshi created Bitcoin because the existing monetary system had just shown the world its fundamental vulnerability, and someone with a precise understanding of cryptography, monetary theory, and human nature decided to build an alternative that could not fail in the same way. 16 years later, the world's largest asset manager is accumulating that alternative at a pace that its own ETF disclosures make impossible to ignore. Governments are still printing. Debt is still accelerating. The monetary architecture that Satoshi was responding to in 2008 has not been fixed. It has been extended, expanded, and complicated. And the people responsible for managing the long-term financial security of millions of ordinary people have concluded that an allocation to the assets Satoshi built is no longer optional. It is necessary. Whether you agree with that conclusion or not, the most important question is simpler than any macro analysis, any liquidity model, or any price prediction. If BlackRock, with access to the best economic research, the most sophisticated risk models, and the deepest institutional relationships in the world, has decided that Bitcoin is a necessary allocation against what the monetary system is doing and what it is likely to continue doing, what do they know that you have not yet fully processed? That is the question worth sitting with. Because in monetary history, the people who asked it early enough still had time to act on the answer.